This is Nightly Business Report with Sue Herrera and Bill Griffith.
Monday blues. Stocks fall to start the week, even though there's increased optimism over trade, an issue that has pushed the market higher in recent months. U-turn, 10 years of rock bottom rates are a thing of the past, and that's making it more expensive to buy a car. Payday. Why this is the time of year many Americans feel like they've hit the jackpot. Those stories and much more tonight on Nightly Business Report for this Monday, March 4th. Good evening, everyone, and welcome. Bill Griffith is off tonight. Stocks fell to start the week. There was some optimism early on that the market would rise on the prospect for a trade deal after reports that the U.S. and China were slowly getting closer to an agreement. It is that same hope that has been propelling the market higher for months, but for whatever reason today, it simply didn't resonate and stocks dropped. The Dow Jones Industrial Average dropped 206 points to 25,819. The Nasdaq fell 17, and the S&P 500 was down 10. Bob Pisani has more on today's decline.
An early rally quickly fizzled out with the Dow falling more than 400 points. It was the biggest one-day decline in several weeks. Why the drop? You know, it's tough to pin the drop on any one theme. This is the kind of action that indicates buyer exhaustion. You know, after all, we've had a big rally, partly on trade talk hopes, and now that a deal is looking more and more likely, stocks took a breather. Call it sell on the news if you'd like. Trade-related groups like technology and industrials were in the red, but we also saw names not associated with trade, like retail stocks, which were strong last week, and healthcare also lagged on the session today. Software stocks like Salesforce also faded, and transportation stocks tumbled for a seventh straight day. Airline stocks in particular, like Delta, were weaker. And again, healthcare lagged. The big pharmaceutical names like Pfizer were all down. So the big issue now is how much more room does the market have to run on just the Federal Reserve isn't going to raise interest rates story this year and on the hope for a China trade deal. Remember, global growth is still weak, and a stronger dollar is also a concern out there. The sectors that have seen the biggest cuts to their earnings estimates so far this year are energy, materials, and technology. That's no surprise. Materials and technology are both closely tied to trade uncertainty. Now, the key to getting stocks back up toward historic highs is to stop that downward earnings revision trend that we've been seeing for several months now. And for that, we just need to see more stability on the global markets front. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And now to trade and a few new developments that could bring the world's two largest economies within striking distance of a deal after months of hot and cold discussions. Kayla Tausche has the details.
A potential détente in the U.S.-China trade war could be just weeks away, according to three sources close to the situation. The two sides continue to negotiate via video conference to reach agreement on outstanding issues ahead of a planned summit for late March at the president's South Florida resort. The deal as it looks now would see China buy more than $1 trillion in U.S. goods over 6 years. China will approve a new law related to intellectual property for foreign companies operating there. There would be broad agreement in several macroeconomic buckets and an agreement to keep talking. It's through that dialogue that the U.S. would try to hold China accountable. And if President Xi doesn't follow through, then the U.S. could reintroduce tariffs with no retaliation. China sees that dynamic as too harsh. While Democrats here in the U.S. say President Trump is rushing a deal that's not harsh enough after walking away from talks with North Korea last week.
I think the president's too anxious to sign a deal. His failure in Hanoi, I think, does create a context where he's looking to put that signature on something, and I'm afraid that it'll fail to deal with the bigger structural problems that we face.
Many Republicans acknowledge the importance of solving these long-term issues, but are willing to give him the benefit of the doubt for now.
The right move is for him to get the best deal he thinks he can get at this time. This is not going to end it. It's not going to end what our continued kind of contentious trade relationship with China. It's going to just bring the temperature down, I suspect.
And the deal would take a lot of the heat off. The U.S. would remove the majority of tariffs it's placed on China, and China would do the same. For Nightly Business Report, I'm Kayla Tausche in Washington.
As negotiators work on a trade deal, Chinese officials are gathering for their major annual parliamentary meeting. called the National People's Congress. The meeting comes as China battles an economic downturn, and investors hope this event will shed some more light on the health of the world's second largest economy. Eunice Yoon is in Beijing.
At the National People's Congress on Tuesday, Beijing's leaders are expected to acknowledge the slowing economy, lowering the growth target to a range of 6 to 6.5%. Investors are also expecting the government to expand its budget deficit. But what's also significant for foreign investors is the new foreign investment law. This will be the only major law to pass this year, and it's meant to even the playing field. It's a way for China to address the trade war with the U.S. The Chinese believe that this new foreign investment law is significant, ending 3 joint venture laws, barring forced technology transfers, preventing the state from illegally setting market access, and allowing foreign firms to help set product standards. The problem is that, as with many rules in China, they look great on paper, but can they be applied evenly and fairly? The best thing one business association official could say about it to me was that at least it's not negative. For Nightly Business Reports, I'm Eunice Yoon in Beijing.
New Jersey's governor is doubling down on raising taxes on that state's millionaires. According to reports, Phil Murphy will outline the proposal in his second State of the Budget address tomorrow. The measure's new tax would hit those with incomes over $1 million and would bring in about $450 million for the state. Well, socialism has become a recent buzzword in politics. In a recent poll, voters prefer capitalism over socialism, yet they also want the federal government to do more, not less. John Harwood joins us tonight from Washington. Good to see you, as always, John. So let's start with the term socialism. What does the NBC Wall Street Journal poll tell us about that?
What it tells us, Sue, is that by almost a 3-to-1 margin, Americans say they have a negative view of socialism. Just 18% view that term positively, 50% view it negatively, which is, of course, is the mirror image of how they feel about capitalism.
Yeah, what does it tell us about the appeal of capitalism?
Well, the 50% support or favorable view of capitalism is down somewhat from what other polls have found in recent years. So it suggests that maybe as people have struggled with stagnant wages over the last several years, especially people in the working and middle classes, that the appeal of capitalism, the shine is off a little bit. But still, it's a clear preference over socialism, and all that explains why it is that Republicans are eager to slap that label onto what Democrats are talking about. And Democrats, with the exception of people like Bernie Sanders and maybe Alexandria Ocasio-Cortez in the House of Representatives, tend to say, no, I'm not a socialist, I'm a capitalist.
All right, so how is this going to play out? Who has the upper hand here?
Well, on the labeling, Republicans have the upper hand. However, you've got to temper that with the idea that if you look at this poll, 55% of Americans say they want government to do more to help them. Well, that's another way of describing what Republicans are calling socialism. People like things like Social Security and Medicare. And the desire for more government assistance is why Democrats go out on the stump and talk about free college and Medicare for all and more infrastructure. People want some assistance.
On that note, John Harwood in Washington. Thanks, John.
You bet.
Time to take a look at some of today's upgrades and downgrades. Kraft Heinz was upgraded to equal weight from underweight at Morgan Stanley. The analyst cites the company's reasonable 2019 profit goals following its recent stock plunge. The price target is $35. The stock rose 2.5% to $33.23. Bed Bath & Beyond was downgraded to underweight from equal weight at Barclays. The analyst says he's disappointed with the company's broad restructuring. The price target is $13. That stock fell 5% to $15.80. Dillard's was downgraded to underweight from neutral at J.P. Morgan. The analyst cites rising inventory levels and a 25% rise in the stock year to date. The price target is $57. The stock fell about 5% to $71.47. Still ahead, are you in the market for a car? Well, you might be in for some sticker shock, and not only because of the car's price. OxyContin maker Purdue Pharma is reportedly exploring bankruptcy. According to multiple reports, the filing would address potentially significant liabilities from thousands of lawsuits alleging that company contributed to the opioid crisis. Purdue has denied the allegations, saying the FDA approvals for its opioids carried warnings about the risk of misuse. More than 1,000 lawsuits have been filed against Purdue and others. SpaceX's capsule had a successful docking at the International Space Station over the weekend. As we reported Friday, the spacecraft is built to carry U.S. astronauts into orbit starting later this year. The mission is considered a major milestone for space exploration since it's part of NASA's push to resume astronaut launches from U.S. soil for the first time since 2011. SpaceX was founded by Elon Musk, who also founded Tesla. And speaking of Tesla, the electric car maker will unveil its Model Y SUV next week. In a series of tweets, Musk said that it would cost 10% more than the Model 3 and have slightly less range for the same battery. Separately, regulators are reportedly investigating 2 fatal accidents involving Tesla vehicles, both in Florida. One involved a Tesla Model 3, the other a Model S. According to reports, the focus of the probes are on the flammability of the vehicle's batteries and Tesla's drive assistance feature. Well, after years of paying relatively low interest rates on auto loans, car buyers are now doing a double take. Interest rates have risen to their highest levels in a decade. Phil LeBeau has more on higher rates and the slowdown in showroom sales.
It's getting more expensive to buy a new car or truck. Not only are automakers raising prices on vehicles, the interest rates on auto loans have soared to a 10-year high. Last month, the average rate for a new car auto loan was 6.26%, up more than 1% compared to a year ago, and well above the average rate from 5 years ago.
So if someone's coming back into the market after maybe years ago paying a 1.9, which was quite common, and now they're up to a 5%, that is a big monetary difference. So we're talking quite a bit of thousands of dollars over the life of a loan.
Why is it costing more to borrow money for an auto loan? One factor is the Federal Reserve raising interest rates, which in turn is pushing up rates on all types of loans. It's also forcing automakers to pull back on offers for 0% financing. Meanwhile, both dealers and lenders are much more selective about who qualifies for the lower rate loans. Even though buyers are being forced to pay more, it's not stopping them from choosing pricier models of trucks and SUVs.
People right now are ponying up and essentially still continuing to buy these cars, although we do think that there is some caution ahead in terms of how long this can last, because we are starting to see sales slow down slightly as people are kind of getting a bit of a sticker shock.
As auto loan interest rates have increased, it's forced a growing number of people to consider leasing instead of buying a new model. While the interest rates may not be much different, generally speaking, those who lease pay about $100 less per month than those who buy a new vehicle with an auto loan. Phil LeBeau, Nightly Business Report, Chicago.
Eli Lilly is cutting the price of a key drug by 50%. That's where we begin tonight's market focus. The drug company will release a generic version of its popular diabetes medicine Humalog, and that new product will target patients who pay for their insulin out of pocket. Eli Lilly says it will continue to sell its branded version at the regular price. Shares fell 1% to $127.46, but they did hit a one-year high early in the session. Biogen is saying that it will buy gene therapy company Nightstar Therapeutics for about $800 million. Nightstar is focused on therapies for inherited eye diseases. Biogen is hoping to tap into the potentially lucrative gene therapy market. Biogen fell 2% to $327.26, but Nightstar soared 66% to $25.18. Healthcare Services Group says that it cannot file its 10K for 2018 yet because the SEC is looking into its earnings per share calculation practices. The company, which provides housekeeping and dining services to the healthcare industry, received a subpoena last March from the SEC in connection with this issue. 10Ks are filed annually and they contain companies' financial information. The shares were down more than 13% to $32.78. AT&T is restructuring its Warner Media division, which the Wall Street Journal says will involve, quote, significant layoffs. The plan includes a revamp of CNN's digital operation and a unit called Warner Entertainment, which, among other things, combines HBO and Turner's entertainment operations. AT&T shares were down more than 2.5% to $29.98. Well, every retailer would love to look into the future to stay just one step ahead of new trends. Today, the industry got its chance to show off what it thinks the future will hold. And the years ahead are dominated by technology. Courtney Reagan is in Las Vegas tonight.
Here at Shoptalk in Las Vegas, hundreds of retailers, brands, tech startups, and investors are coming together to bet big on the future of an industry in a period of rapid transformation. The tech presentations and exhibitions are among the most attended because it's not enough to just have the best products. Retailers have to serve shoppers better, wherever and however they want to shop. It's leading established retailers to talk to startups about offering consumers options for services like faster delivery, easier returns, and augmented reality shopping.
It feels like this is a giant demo day where all these tech companies at various levels of funding are pitching the retailers and the brands how they can make them better.
Bob's Discount Furniture announcing new augmented reality technology in partnership with Marksent, allowing consumers to try out new furnishings virtually. Macy's is already working with the startup for virtual reality furniture shopping and says it's increasing the average order value by up to 50 to 60%. If retailers can get consumers to shop online and in store, the total spend increases. Nordstrom forecasts shoppers that do both will spend 4 to 11 times more than shoppers that use just one. It's part of the reason the department store is experimenting with physical e-commerce hubs that also offer services that can't be done online. Nordstrom local stores in Los Angeles don't have inventory like its typical locations, but instead offer a point for online order pickup, alterations, and returns. Co-president Eric Nordstrom hopes bridging consumers' digital and physical experiences will ultimately make shoppers' lives easier, increasing loyalty and spending.
We just keep learning again and again, and I guess we should have to learn this. Do what the customer wants. The customer wants to get in and out quickly, and there's a more convenient way of doing that. It does pay off for us.
Meeting consumers' desire for instant access, around-the-clock accessibility, and fast turnaround, all now the norm, has large retailers racing to fill that need, and quick.
When we look in hindsight, we don't think the strategic choices or direction has been off. We think we've been too slow. We think we need to be more agile.
And if there's one thing tech startups offer that bigger retailers need, it's speed. For Nightly Business Report, I'm Courtney Reagan in Las Vegas, Nevada.
And if you're planning on going shopping, you are not alone. The average American family spends a lot more this time of year thanks to Uncle Sam. Steve Leisman explains.
New Jersey resident James Zeguler counts on his annual tax refund, and this year he knows exactly what he's doing with his check.
Last year we went to Walt Disney World. This year we're going to Miami.
Zeguler, it turns out, is like a lot of Americans. A new study by the JPMorgan Chase Institute looked at anonymous data from the spending of millions of Chase credit card holders and found the tax refund is the biggest payday of the year for nearly a third of households.
We were most surprised to learn that the tax refund is the mechanism by which people step up year to year. And most people think of it as a year-end pay increase or otherwise, but what we find, it's really this tax refund where they reset and they rebalance their spending.
They do more than rebalance. The study found that spending spiked 74% in the week after the check arrives in the mail from Uncle Sam. The average refund equal to 6 weeks' salary for the average recipient.
I put some in savings, and then if there's something that I need or my children need, I get it for them.
People spend their tax refund differently than they spend their general day-to-day spending, and so we see much more emphasis on durables. They're paying down credit card debt. They are just taking out more cash instead of buying services, non-durables, and food.
There were fears that because of last year's tax cuts, refunds in 2019 might run lower, but that's proving not to be the case. The number and dollar amount of refunds is running a bit behind, but about a third of the way through the filing season, the average refund is a bit bigger. And that's good news for Mr. Zegular and his planned trip to Miami.
Me and my girl, because we live check to check. So we got a little nervous, but it worked out good for us.
For Nightly Business Report, I'm Steve Leisman.
Coming up, a Hollywood drama. The movie industry's biggest director is taking on the company that's pushing to change the entertainment business. Director Steven Spielberg wants to ban Netflix from the Oscars. The legendary director of popular movies like E.T. and Schindler's List plans to support a rule change that would prevent movies that debut on a streaming service from Oscar eligibility. Matt Harrigan, Director of Equity Research with Buckingham Research, joins us now to talk about whether or not streaming is a missed opportunity for Hollywood. Nice to have you here, Matt. Welcome.
Thank you.
I mean, the obvious answer seems to be, yeah, it is a missed opportunity. Would you agree with that?
Well, I think all the studios have benefited somewhat from Netflix in terms of selling content. I mean, they were the foundation for Netflix's early success, including Disney. The problem was, to a certain extent, they created a monster. And I think that Netflix has been extremely disruptive to the mid-budget movie business, romantic comedies, et cetera, in theaters. It really hasn't had very much effect at all on, let's say, the Avengers or the high-end animated movies. But in terms of the genre of movies that the Academy Awards is generally focused on, it's been very, very transformative.
Yeah, what does this do if this rule goes through and Steven Spielberg is supporting that rule? What does that do to the streaming business per se?
Well, I don't think it makes a whit of difference to Netflix. I mean, I think that they enjoy the critical acclaim, but the money from the box office just really isn't that important to Netflix at this point.
So, what does Hollywood need to do to either get on the bandwagon and partner in a different way with Netflix than they have? Obviously, as you mentioned, they kind of created the monster to a certain extent. What do they have to do to change?
Well, a number of these studios are pulling their content. I mean, most notably, Disney, as everyone knows, which particularly if the Fox content you layered on is by far the most formidable. I don't want to say adversary, but more complement, to Netflix. And of course, Warner Media is doing the same thing over at AT&T. Hence, in part, the reorganization that we've seen over the last couple days. But I think the talent is realizing that there's very good content on Netflix, and Netflix is really up the pay scale. So I think that Steven Spielberg can complain, and certainly he has more recognition in the broad public than any of these other directors. But that's not what ultimately is going to drive the business. I think when you look at in-home, I mean, people are very acclimated now to binge viewing TV shows. And you've got more 4K TVs. You're going to have 8K TVs early in the next decade.
And as you know,
the screens get bigger and bigger. So there's certainly a social aspect to the theater experience. It's always going to be there. But I think you have to face reality, and these windows are going to get more and more compressed for all but the biggest movies.
Matt Harrigan with Buckingham Research. Thank you, Matt.
Thank you.
And finally tonight, are you in the market for real estate? Well, according to this listing on Craigslist, you can get almost an entire town in Georgia for about the same price of a typical home in San Francisco. 37 parcels of property, including a famous opera house, a restaurant, a Victorian hotel, along with 40 acres of land, are on sale for $1.7 million. And that price is about the same as the median cost of a single-family home in parts of San Francisco. Wow. That does it for Nightly Business Report tonight. I'm Sue Herrera. We want to remind you this is the time of year your public television station seeks your support. We thank you for that, and we'll see you tomorrow.